If you want to understand how professional traders trade using smart money and ICT concepts, this video will give you the complete framework. We break down the liquidity concept in trading, external liquidity trading strategy logic, and a complete guide to market structure that explains how price truly moves. Instead of treating scalping trading strategy models, supply and demand trading strategy ideas, or Forex professional trading strategy setups as isolated systems, we connect everything through one unified smart money structure. Welcome back to the ComLucro channel. In this video, you will see how ICT strategies like the silver bullet, Cameron's model, turtle soup, and fair value gap execution all operate within the same structural logic. By combining liquidity, price action trading strategies, and market structure trading strategy principles, you will understand not only where to enter, but why those entries work and how they align with institutional behavior. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. Now, if you would like to jump directly to a specific ICT strategy or concept, you can use the chapters listed in the video description and navigate to the section that interests you most. However, before we break down powerful ICT strategies like the silver bullet and other smart money models, we need to understand the engine behind them. What is liquidity, and how does it really work in the market? To answer that, we must begin with a clear introduction to smart money and the fundamentals of liquidity within the smart money concept. Because without understanding liquidity, no strategy will make sense in real market conditions. Imagine that major financial institutions, often referred to as smart money, are interested in purchasing a currency pair. To do this, they require a significant number of sellers and corresponding sell orders in the market. This is essential because without available sellers, no transactions can take place. Therefore, smart money needs to trigger the stop-loss orders already present in the market to execute their buy or sell positions. It is often speculated that smart money may manipulate the market, creating scenarios that deceive traders into believing they have a clear understanding of price action. This situation can create an illusion among retail traders, making them believe they are trading on the right side of the market. However, contrary to their expectations, the market moves in the direction of their stop-loss levels, and after triggering these stops, it resumes its normal trend. To thrive and succeed as a profitable trader, identifying liquidity on the chart is essential. These areas, where significant volumes of orders are present, provide valuable insights into market dynamics and help prevent substantial losses. Liquidity can be classified into two types: static liquidity and dynamic liquidity. And this distinction becomes extremely important when we later look at how strategies like the silver bullet identify sweeps and reversals. Let us briefly explain both. Dynamic liquidity refers to the factors that influence market direction and movement. In simpler terms, it represents the elements that drive market movements. To better understand this, imagine a market structure like a rally wave consisting of a high and a low. These highs and lows represent external liquidity. External liquidity pertains to the highs and lows within a rally wave. Conversely, the fair value gaps found within the range of the high and low are considered internal liquidity. Price in the market always moves between internal and external liquidity. Think of it as a continuous cycle where price moves either from internal to external liquidity or from external to internal liquidity. Looking at this schematic figure, it shows a rally wave moving upward, sweeping the external liquidity gathered above the previous high. After this, the price shifts toward internal liquidity, indicated by this fair value gap, to fill the gaps left behind from internal liquidity. This movement between external liquidity and internal liquidity is exactly the same logic used inside many ICT strategies. The price then transitions back to the external phase. Essentially, price moves from the fair value gap to external liquidity by sweeping liquidity above this high. With the external liquidity swept, price then aims to rebalance by targeting internal liquidity again, filling the most recent fair value gaps. Shifting our focus, let's examine the details of static liquidity. Static liquidity refers to specific zones in the market where a large pool of money is resting, such as stop losses or buy and sell orders. When a trader gets stopped out of a position, the market absorbs the funds associated with that stop loss. Recognizing a liquidity sweep pattern before the price reaches our point of interest is crucial. This pattern confirms the strength of our supply or demand area. We use liquidity sweeps as a confirmation factor. The idea is simple. The market requires liquidity for momentum. If the price doesn't sweep liquidity before a key level, it often uses that zone as liquidity to fuel its momentum. Static liquidity can be identified in various areas on the price chart, such as below equal lows and above equal highs, above swing highs and below swing lows, below or above dynamic trend lines and channels, inside order blocks, below or above support and resistance levels, in Fibonacci retracement levels, and near the daily candle's body and wick. Having a solid grasp of static liquidity zones reveals their profound impact on market price direction. Neglecting them can lead to substantial losses. Some of these zones and patterns are especially important as they are widely recognized by traders, attracting more stop loss and pending orders, increasing the likelihood of price moving toward them to absorb liquidity. Now that you understand how liquidity forms and how price moves to absorb it, let us begin applying these principles inside real ICT trading models. This is the first strategy we will break down, and by the end of this video, we will cover 4 more strategies built on the same liquidity foundation. Let's start with the silver bullet trading setup. The silver bullet is an ICT trading strategy that combines 3 main concepts: market structure shift, liquidity sweep, and fair value gap. To trade the silver bullet, you wait for price to break above the day's high during the London or New York session and then quickly return inside the range, taking out the buy-side liquidity. This liquidity sweep above the key structure of the day signals a possible upcoming reversal. Next, we wait for a bearish market structure shift to confirm this reversal. A bearish market structure shift happens when price breaks and closes below the recent swing low. This shows that demand is no longer in control and price may start pushing to the downside. Then mark the bearish fair value gaps that formed along the way as supply zones. Set a sell limit order at the start of the FVG zone and wait for price to pull back into this area. If new FVGs form, you can plan future trades, but always follow a proper risk management plan. Similarly, in the bullish scenario, you wait for price to sweep liquidity below the day's low. A valid liquidity sweep pattern forms when price breaks below a level, but immediately moves back inside the range. Next, wait for a market structure shift to confirm the reversal. Finally, mark the fair value gap and set up your trade. If there is only a small fair value gap, do not forget to use a slightly larger stop loss to protect your trade from normal market fluctuations. At this point, you may have noticed that one element keeps appearing inside this setup: the fair value gap. We use it as the precision entry after liquidity is swept and structure shifts. But if you truly want to understand why this entry works, we need to slow down for a moment. What exactly is a fair value gap, and why does price react to it so consistently after a liquidity sweep? Before we continue building more strategies, let us break down this concept in detail. A fair value gap is a 3-candle pattern that reveals an imbalance in price delivery, creating a gap between the shadows of the first and third candles. This imbalance often appears immediately after a liquidity sweep or a strong impulsive move, which is why it becomes so important in ICT strategies. Let us first look at the bullish fair value gap, often referred to as BISI. BISI stands for buy-side imbalance and sell-side inefficiency. A bullish fair value gap forms when the upper shadow of the first candle does not overlap with the lower shadow of the third candle, leaving a clear gap between the two. To make this clearer, let us compare 2 price movements, one where a fair value gap is present and one where it is not. On the left, there is no overlap between the upper shadow of the first candle and the lower shadow of the third candle. which creates a fair value gap. On the right, the upper shadow of the first candle overlaps with the lower shadow of the third candle. The bearish fair value gap is commonly called SIBI, which stands for sell-side imbalance and buy-side inefficiency. A bearish fair value gap forms when the lower shadow of the first candle does not overlap with the upper shadow of the third candle, again creating a gap between the two. Let us make the same comparison for bearish structures. On the left, there is no overlap between the lower shadow of the first candle and the upper shadow of the third candle, resulting in a bearish fair value gap. On the right, the lower shadow of the first candle overlaps with the upper shadow of the third candle, which means there is no fair value gap present. Another important concept related to fair value gaps is known as consequent encroachment. This simply refers to the midpoint of the fair value gap or the 50% level of the gap. Fair value gaps can act as areas of support and resistance, similar to other structural levels. In many ICT models, this is exactly where precision entries occur after liquidity has been swept and structure has shifted. Because of this, it is important to observe how price reacts to the boundaries of the fair value gap and to the consequent encroachment level. Let us start with bullish fair value gaps. In an ideal scenario, price reacts at the upper boundary of the fair value gap by trading into it and then closing above it. This behavior suggests that price is respecting the fair value gap. Another valid reaction occurs at the consequent encroachment. In this case, price pierces the midpoint of the fair value gap and closes above it. It is common to see price retest the consequent encroachment shortly after. In the next illustration, you can see the bearish version of a fair value gap reaction. The principle remains the same, but the structure is inverted. Just like other forms of support and resistance, price can also move through a fair value gap and later react from the opposite side. In ICT terminology, this behavior is called a fair value gap inversion. On the left, you can see a hypothetical example of a bullish fair value gap inverting and leading to bearish price movement. On the right, a bearish fair value gap inversion leads to bullish price movement. This behavior closely resembles the classic switch and test seen with many support and resistance levels. Beyond fair value gaps, the ICT method also highlights related concepts such as volume imbalances and gaps. A volume imbalance occurs when there is a difference between the open and close of adjacent candles, even though trading activity exists within that area because the candle shadows overlap. A gap, on the other hand, occurs when there is a complete absence of trading activity between candles. In a bullish gap, there is space between the high of the first candle and the low of the second candle. In a bearish gap, there is space between the low of the first candle and the high of the second candle. In the illustration, you can see the bullish versions of a fair value gap, a volume imbalance, and a gap placed side by side for comparison. In the following illustration, the bearish versions of all three patterns are shown. Keep in mind that fair value gaps, volume imbalances, and gaps can often be used in a similar way when analyzing price behavior and potential reaction areas. Now that you understand how fair value gaps form, how they react, and how they can even invert, you can begin to see that they are not random patterns. They are part of a larger liquidity framework. In ICT models, fair value gaps are often the precision point where entries occur after liquidity has been swept and market structure begins to shift. With that foundation in place, let us continue breaking down how these concepts are applied inside complete trading models. Number 2, Cameron's model. This trading model is made up of three main components: a draw on liquidity, a stop raid, and the entry. So what is a draw on liquidity? It basically means finding a key liquidity level that price is moving toward. In simple terms, the market often moves to areas with resting liquidity, such as equal highs, equal lows, or obvious swing highs and lows, because that is where many orders are waiting to be filled. So in the first step of Cameron's model, look for a key high or low on the 1-hour chart that price is moving toward. As you can see here in this example, we have this swing high on the hourly chart and price is drawing up toward it. We can anticipate price reaching this high because that is where liquidity exists. If you cannot find any clear draw on liquidity on the 1 hour, you can zoom in to the 15-minute chart. The next step is identifying a stop rate in the opposite direction of our draw on liquidity on the 5-minute chart. So let's switch to a lower time frame. Keep in mind that the liquidity zone is above us. Now, we're looking for a swing low to be taken out, which is called a stop rate. Finally, we look for fair value gap formations to set a buy limit. If you cannot find any FVGs on the 5-minute chart, you can zoom into the 1-minute or even the 30-second chart. In the bearish scenario, you simply find a key liquidity zone that price is moving toward. Then zoom into the 5-minute chart and wait for a stop rate above a recent swing high. Find a fair value gap and set a sell limit at the start of the FVG and place your stop loss above it. Do not forget to give price some room to breathe, so do not keep your stop losses too tight. Number 3, inversion fair value gap. For a quick reminder, a fair value gap, or FVG for short, is a 3-candlestick pattern where the first candle's low does not overlap with the third candle's high, or when the first candle's high does not overlap with the third candle's low. Now, what is an inversion FVG? An inversion is a failed fair value gap that gets disrespected by the market. For example, here we have a bullish imbalance that caused this FVG. When price pulls back to this area, we expect a rejection to the upside and a continuation of the uptrend. But you can see that the next candles close over the FVG, completely disrespecting it and creating an inversion. Now we can place a sell limit and expect price to either retrace back to this zone or move lower. Keep in mind that this method works much better when combined with other concepts. For example, if an inversion FVG occurs after touching a higher time frame key level or a higher time frame trend line, it has a higher chance of working out. Now, here is an extra tip to help you know whether an FVG is going to hold or fail. The midline of the FVG is very important. What I like to see with the midline is that price comes down and respects this level, then moves higher. But if price comes and violates this level, I can expect it to move lower, disrespect the fair value gap, and create an inversion. Number 4, turtle soup. The turtle soup setup is another trading model that combines the concepts of market direction, the liquidity raid, and fair value gap entry. A high probability bullish turtle soup setup occurs when price raids liquidity below a recent low while resting above a bullish fair value gap. Similarly, a bearish turtle soup occurs when price raids liquidity above a recent high while resting below a bearish fair value gap. Now, how do we enter the market? As you can see here in this example, we have a clear uptrend, so we are only interested in buying opportunities. But where should we set our entry? This area of demand looks like a promising zone to place a buy limit. However, as smart money traders, we know that this area is where many retail traders will place their entries and set their stop losses just below. This means there is a high chance of manipulation at this level to target the sell side liquidity. If you also check the left-hand side, you can identify a fair value gap, which can be a great demand zone for entering a long position. To trade the turtle soup setup, we wait for price to reach the liquidity below the swing low and show signs of rejection at the FVG. Once price returns inside the range, we can open a buy position with our stop loss placed below the zone and target the next important level ahead of the market. Next, we have candle range theory. Candle range theory, or CRT, is a trading concept that focuses on the price range, high to low, of a single candlestick on the chart. The typical concept of this strategy usually involves 3 candles, and each candle has its own important role. The first candle defines the range. The second candle creates the sweep. The third candle provides the entry. Let's break this down step by step as a concept. Starting with the first candle, candle range theory suggests that every candle's high and low act as the most important liquidity levels that the following candles will use as targets. If the second candle attacks the liquidity above the candle range high and immediately reverses, there is a high probability that the next target will be the liquidity below the candle range low. But how do we actually trade CRT in an uptrend? Mark the high and low of a bearish candlestick during the correction phase. If price breaks and closes below the low, we skip this setup and move to the next one. But if price sweeps the liquidity and quickly returns back inside the range, then we have a valid CRT trading setup. Next, zoom into a lower time frame to find an entry. Look for bullish fair value gaps that form and set a buy limit. The stop loss should be placed below the zone, and the target will be the next important level ahead of price. Keep in mind that you can use any time frame combination for this trading setup, but one of the most popular options is to use the 4-hour and 1-hour charts for the higher time frame and the 5-minute or 15-minute charts for the lower time frame. Now that we have seen how liquidity is swept and how fair value gaps provide precision entries inside these strategies, we need to place everything inside the larger structure of the market. Liquidity grabs, structure shifts, and momentum changes do not happen randomly. They unfold within a clear structural sequence on the chart. To fully understand why these setups work, we must revisit the fundamental way price action develops. Price action is composed of 3 main sub-movements: impulse, correction, and continuation. And each one is created by internal candlestick patterns. So let's break them down one by one, starting with impulse moves. Impulsive movements are strong, decisive pushes in the direction of the dominant trend. They appear when price accelerates clearly, either driving upward in a bullish leg or falling sharply in a bearish one. This phase is powered by firm market sentiment and obvious control from buyers or sellers. For instance, look at this bullish candle sequence. We can see price climbing through a combination of smaller impulses and brief pauses. Together, these create the internal structure of what we classify as a single bullish impulse leg. And why is this treated as one smooth movement? Because at no point along this path does price break or even sweep the liquidity beneath any of the previous internal lows. That specific detail is what keeps this entire leg categorized as a clean, uninterrupted bullish impulse. From a candlestick standpoint, we label this internal movement as our impulse leg. After that, a valid pullback appears, confirmed by this red bearish candle that breaks and closes below the previous bullish candle. This marks our minor correction. Price then builds another bullish impulse, which we call a minor continuation. This sequence repeats over and over again: impulse, correction, continuation, until price reaches this swing high and eventually transitions into a deeper corrective phase. Now let's move to the corrective movement. A corrective move is a temporary counter-trend phase or retracement that moves against the main direction of price. We identify a correction when price breaks below the most recent pullback or internal low, or sweeps its liquidity through a candle wick. In this example, 3 red candles form the correction, clearly breaking and sweeping the previous pullback's low. After this, price returns to its upward movement and eventually breaks above the most recent swing high. This confirms the start of the continuation phase. However, in this scenario, if price fails to break the most recent pullback or internal low and instead continues driving upward, then we do not have a valid corrective movement. In that case, this entire sequence should be viewed as one continuous impulsive leg with no correction in between. It is essential to remember that these rules apply across all time frames and on any chart built from pure price action. Now let's move on to one of the most important components of market structure: the market structure shift. Imagine the higher time frame trend is bearish, with price forming a pattern of lower lows and lower highs through a series of impulse and corrective legs. If we zoom in to the most recent retracement or corrective phase on a lower time frame, we may see price building a short-term bullish structure like this. During this retracement, what we want to see is price pushing into a key higher time frame resistance zone and showing rejection. This resistance could be a bearish fair value gap, an order block, a breaker, or a mitigation block. If price then breaks below the most recent pullback formed just before tapping that resistance area, we get a market structure shift on the lower time frame. This shift suggests that the temporary bullish move is likely ending and that bearish momentum is returning. At this point, price is expected to realign with the dominant bearish trend of the higher time frame. and it is crucial to understand that for the structure shift to be valid, price must clearly break and close below the swing low of the most recent pullback. A wick that only touches or penetrates the level is not enough. We need a full close beneath it to confirm the shift. Now you might be wondering how we can confirm whether this bearish move is a true structure shift rather than just a normal bearish correction before the next push upward. The main reason we classify this specific move as a market structure shift is that price tapped into an unmitigated resistance zone, such as a supply area, a fair value gap, or a breaker, and then reacted sharply from that level. It's important to understand that not every corrective leg qualifies as a structure shift. For the shift to be valid, the move must originate from a key unmitigated level on the higher time frame. This is why a solid understanding of market structure is so critical. Without it, you are far more likely to misread the chart and expose yourself to avoidable losses. Now, once the bearish structure shift is confirmed and we anticipate lower prices, the next step is to search for a selling opportunity. At this stage, you will want to locate a bearish fair value gap, an order block, or an inverted fair value gap formed within the structure shift leg. These zones often act as magnets, drawing price back into them before the move continues downward. In that situation, you would place a sell limit order and target the closest liquidity pool on the current time frame, or aim for higher time frame liquidity levels if you are pursuing a larger move. Throughout this video, you have seen how liquidity drives price, how fair value gaps reveal imbalance, and how market structure defines when momentum truly shifts. None of these concepts work in isolation. They form a unified framework that explains why ICT strategies like the silver bullet and others produce high probability setups. When you understand how liquidity is swept, how imbalance is delivered, and how structure confirms direction, you are no longer memorizing patterns. You are reading the engine behind price itself. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include smart money concepts, technical analysis for day traders, trading psychology, and the Wyckoff method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.